Okay, we are live everywhere, but I'm just going to give it 2 more minutes so that everyone starts streaming into this live stream, and then we'll bring you onto the stage, Vaibhav and Aditya. Okay. Okay, I think we can start. We have a decent people who have tuned in. Aditya and Vaibhav, if you can please come onto the stage now, the virtual stage, at least in this case. Um, uh, okay. Hello, everyone. Welcome to our Alt Extra webinar where we discuss the details this time of an online bond platform provider, aka the OBPP framework, and how it is designed to protect the interest of the retail investors. And today, to discuss this topic, we have Aditya Bhargava and Vaibhav Laddha with us on this panel. Let me quickly introduce both of them for all of you. I'll start with Aditya. Aditya Bhargava is a partner at Trilegal and is a leading practitioner experienced in debt resource raising by domestic financial institutions through debt capital markets, mostly in private placements and structured finance and also securitization. He has worked closely with several NBFCs as well as various upcoming NBFCs as well. Aditya has also been an advisor to a couple of OBPP platforms and is also a part of the SEBI securitization committee, along with other notable lawyers and industry participants. Owing to his in depth expertise, he has been recognized by leading legal directories, including as a recognized practitioner in banking and finance by Chambers and Partners in 2019 till 2021, a recommended lawyer by Legal 500 in 2024, notable practitioner in banking and finance by Asia Law in 2022 to 2023, and IFLR 1000 in 2021. Uh, Two of Aditya's previous representations have been recognized as the most innovative deal of the year in the Indian Securitization Awards in 2021 and 2023. Lots of awards, Aditya, if I must mention that. Pretty solid. Um, I'll move on to Vaibhav. Vaibhav Laddha is the CEO of Grip Invest. Grip Invest, as you might know, is a high yield investment platform offering fixed income investments to retail investors starting at just 1,000 rupees. Grip is one of the leading OBPPs and also one of the founding members of OBPP Association. Vaibhav, over the last decade, has held leadership positions scaling early stage startups both in India and the US, focusing on creating structured financial products, accessing the private wealth ecosystem, and building consumer brands. He holds an MBA from the Darden School of Business, University of Virginia, and is also an alumnus of IIT Delhi. So, welcome, Vaibhav and Aditya. Thank you. It's a pleasure to host you today for this webinar.
Thank, thank you, Yash.
Thanks. Thanks, Yash.
Awesome.
As you.
Okay, I'll quickly set some agenda or context for our audience. So, today, along with these two guests, we'll discuss the importance of regulation. Regulation is something very, very fundamental, but, a lot of retail investors maybe just don't understand either its importance or completely ignore the need of regulation. So, we'll discuss regulation, some key features of the OBPP framework as well, pros and cons of that framework, and, much more other things around regulation. So stay tuned till the end of this webinar to get the maximum benefit out of it. Uh, I'd like to let the viewers know that this is the seventh webinar in our Alt Extra series, which is curated by Alt Investor. Alt Investor runs India's largest community on alternative investments, and the Alt Extra series is powered by Grip Invest. I am your host. I am Yash Roongta, and I'll be the host for this whole webinar series. While I do discuss some key questions I have on this topic for these two gentlemen, I request the audience watching this live to keep their questions incoming. There'll be a chat box wherever you are watching this live, and we'll pick up as many questions at the end of the discussion and get them answered for you. Awesome. Okay, a lot of housekeeping is already done. So Aditya and Vaibhav, ready to get started? Dive into the questions. Yeah.
Sure.
Okay. Perfect. Aditya, the first one is for you. I'd like to understand your opinion of the regulators in general, that is the RBI and SEBI. I think, are they too proactive? Are they too stringent? Or,
Mhm.
any other thoughts that you have? And, can we make a comparison of the Indian regulator with the Western regulator as well? Maybe, someone in the West, in UK, like the FCA, or in the US.
Certainly, Yash. First and foremost, thank you. That was a very nice and warm introduction. And to be perfectly honest, a lot of these awards are very frankly speaking based on market feedback. So, feedback of, say, industry participants such as you and all of that. So, keeping that aside, let's actually provide a bit of a 30,000 feet overview of the regulation, or rather, how the approach that is taken to regulation by Western regulators and Indian regulators, and then we can probably focus even further on why people might have some or the other opinion about Indian regulators. To start off with, if you think about it, say in the modern industrial or post-industrial era, you've essentially had the UK as a really, really developed market from, say, perhaps the early 1800s, if you will. If you think about it, a whole lot of, say, cross-border financing and a whole lot of, say, sovereign financing was anyway being done in the UK financial markets way back when, say, since about 1800 or so. You had the turn of the 19th century or the 20th century where, say, the US started acquiring prominence as far as the financial markets are concerned. And then, of course, it became the preeminent financial market, and New York pretty much became the center of the financial universe. Effectively, what you're looking at is that these two jurisdictions have had a massive, massive head start. Added to the fact that even if you look at, say, Europe, whether you have the Hanseatic League or whether you have say the Italian banks or say any of the continental European banks, they've essentially had a whole lot of runway, a whole lot of, shall we say, practice at doing what we do, and which is essentially a Western financial construct, which is now more or less permeating the entire financial universe as we speak of. So, yes, there will always be some sort of a difference between how the West perceives regulation and how India perceives regulation. So, that's one. As far as the West is concerned, what you're really looking at here is that there tends to be a strong tendency, if you will, towards principle-based regulation rather than prescriptive regulation. Whereas if you look at India, which, to be perfectly candid with you, while we've had a lot of industrial and financial history, in the current financial construct, we are still, I wouldn't say new to this, but we are still finding our feet. We are still finding some degree of position, that you will. So you see that there is a whole lot of prescriptive regulation. Even if you look at, say, the evolution of Indian regulation way back from, say, the 50s and the 60s, and say post the Indira Gandhi nationalizations to even, say, the Manmohan Singh liberalization to even right now, you see a gradual evolution from a highly prescriptive set of regulations to a set of regulations which have gradually become a more viable, a more feasible mixture of prescriptive regulations and also, say, principle based regulation. The one thing which you do see as far as the West is concerned is that there tends to also be some sort of a imperative or some sort of a thought process that, look, all regulations need to be front loaded, or there needs to be some sort of, shall we say, wriggle room that is provided, in that, before a regulation becomes active, you pretty much have some sort of a discussion paper that's actually floated around. comments are received on it, and even when the final regulation is issued, say for instance the EU, there is always a compliance period of anything between 6 months to a year that is actually provided, and many a times that gets extended as well. And that's something which you don't see in India. There are various reasons to it, but if you look at how the regulator is actually focused or is actually, or if you look at the regulatory bent itself, you'll see that whether it's the RBI or whether it's SEBI, the strong streak of regulatory intent that is coming across all Indian regulators, whether it's RBI, SEBI, the insurance regulator, the pension regulator, and so on and so forth, is that there needs to be some degree, or rather a very, very high degree of customer protection. Customer protection in India is merely and entirely focused on retail participation and protection of the retail customer. So, effectively speaking, the thought process tends to be that look, from an institutional perspective, perhaps a market participant is mature enough or is sensible enough to understand the risk, absorb the risk, maybe even suffer the risk, if you will. But that's not something that can be provided to a retail participant. So effectively, what you see here is that there is some sort of an evolution towards a mix of prescriptive and principle-based regulations, which is diametrically opposite to what you have in the West, which is entirely, say, principle-based regulation. And there is also this thing that regulation in India tends to be, well, whether, I mean, we can all have opinions about it, but some perceive Indian regulation as being knee-jerk, in the sense reactive, if you will, rather
Hmm.
than say something which is foresighted. I won't use the word proactive, but something which is foresighted, something which is looking to stay abreast of the market and looking to, actually foster it and develop it and so on and so forth. However,
Hmm.
I'd say that, given the state of where we are right now, given the state of our development, we are not too far away from where, say, New York was as a financial market in, say, the early 1920s and so on. Which is not to say that we are 100 years behind, but which is certainly to say that, look, position to position, we are fairly, keeping abreast, in the sense that, look, again, if you look at what the US Fed did, the US Comptroller of Currency did, they too also had a fairly consumer focused bent. If you look at,
Hmm.
say, the current post 2008 regulations, also, they too have a fairly consumer centric bent. So I'd say that
Okay.
if you were to put things in a nutshell, India tends to be a very consumer centric retail environment, rather than, say, an environment where perhaps, there is, it certainly does not tend to be a laissez-faire environment, and every regulatory move can be traced back to ultimately protecting the retail customer, which is why
Okay.
you see that the Indian regulations tend to be more prescriptive. And also, I mean, it tends to give a shorter leash to market participants. And that, I'd guess, would be my view on things right now.
Got it. Okay. So, Aditya, you have probably been in the finance space a lot, advising a lot of fintech players, NBFCs and OBPPs.
Mhm.
How important, from your perspective, it is to, make any financial product, you know, big in India? So, we always talk about mutual funds, fixed deposits. Those were products which were unregulated for a while, and
Mhm.
then, regulation came in and they became big. We
Mhm.
have now bonds which are going probably the same way, but we still have a lot of unregulated platforms which are operating, and SEBI is not doing a whole lot about them as well. So, what's the general process that the regulator follows to, identify that, oh, this is a new theme, this is a new product, this is probably taking off. Maybe we should try and regulate it, or they take the action in the other way around. This is not good in the interest of the retail investors, and maybe we should close it. How does that process work?
Look, to be very honest, your guess is as good as mine. But empirically, if you look at it, one would say that, so the Indian regulator is actually a fairly sensitive regulator and is actually a fairly astute regulator, is my view on things. They don't always get things right, is one way of looking at it, but they do get a fair bit right as such.
Okay.
So effectively, the way I would perceive this is that the Indian regulator, whether it's an SBI, sorry, whether it's an RBI or a SEBI, they
Hmm.
probably let the market develop a little bit. There is some sort of
Okay.
a cost benefit analysis which probably happens in the background. For instance, you can't just chase after just about each and every product there is. For instance, it might just be that the product actually turns out to be useful. Now,
Hmm.
again, coming back to a very interesting point in your lead in, I'd say that regulation of a whole lot of financial products actually made them more widespread, made them more trusted, made, you know, the Indian public confident of investing in them. For instance, if you look at
Hmm.
the various developments that have happened in the mutual fund space, I mean, I'll tell you a very anecdotal example. I mean, I was speaking to someone the other day and they were talking about investment in a mutual fund. And
Hmm.
someone actually told me that, look, I can now see the riskometer, which SEBI now requires each and every mutual fund to have. And that's not only a very cool thing, but that
Hmm.
actually makes my life a lot easier because, look, someone has already done the pre analysis for me and
Hmm.
has told me that these are the four, five, six, seven things that I need to look at for me to be in a position to actually make a decision. I don't need to read a 300-page prospectus or a scheme document or anything of that sort. I
Hmm.
can start my life investing in a mutual fund by just looking at the riskometer and then, depending upon my appetite for analysis, go further down. Effectively, if you
Makes
look at
sense.
various stats that are happening out there, that are out there, they'll probably tell you that, participation in mutual funds is increasing by a fairly rapid amount on a Y-on-Y basis. So much so that you probably have banks competing with mutual funds for deposits, or, typically the SIP is the enemy of the deposit, if you will. So
Hmm.
effectively, what I'd like to say here is that regulation actually improves the permeation of a financial product rather than decrease the permeation of a financial product. Regulation
Hmm.
fosters confidence, confidence fosters participation, participation obviously fosters growth for all of us.
Awesome. Makes sense. Weber, I'd like to come to you. Taking what Aditya said at the end, and probably taking Grip as an example. Grip was an unregulated platform offering deals via LLP structure before March 2023. Has regulation, the OBPP regulation, really helped you scale, or it has been the other way around?
Right. Thanks, Yash. Thanks for the forum to participate here. So just for the record, Grip was not providing unregulated products. Those products were still regulated by MCA. And
Hmm.
when we call them unregulated now from a lens of an OBPP, Grip was not unregulated by choice. It was just that the regulations didn't exist at that time. And yeah, like Grip was the first one to apply for the OBBP license. We were the first ones to get this license. I think within 3 months of the regulation coming in, we had applied for the license, and I've gotten it another 3 months. So we have been, like very comfortable following the regulations. In fact, today, if you see, and Aditya touched upon it also, if you see, to build a large scalable business today in fintech, and especially if you're talking about investments and wealth and dealing with people's money, the only way to build a large scalable business is to be on the right side of the regulations, right? So we are, I think regulations have helped. Actually, regulations do two things. One, from an operator point of view, from Grip's perspective, regulations bring clarity on what you can do and what you can't do, right? For example, in this case, we can only bring regulated products on an OBBB regulated platform, right? So that's a massive clarity on what we can do as an operator. Uh, and then on the other side, from an investor's perspective or from a user perspective, regulations build trust automatically. Okay, and that's like I am investing into a regulated platform, so there are other regulators, doing the scrutiny, um, and that trust fosters the confidence, and that is actually that fuels the investor awareness for us while having that confidence, right? Aditya gave a beautiful example just now how rating has done that for for retail investors without going into the need of actually scraping through dense prospectus, etc., etc. So in this case, we all our products are rated, and that automatically builds that confidence for the users to participate into. So in the longer run, I think there's no debate that regulations have helped us grow and build that confidence. I think in shorter term, you might, feel that urge to venture into unregulated things for that short term growth, but we are very comfortable staying away from that, and we want to be, fully within the purview of regulations.
Sure. So, Weber, can you, while you are speaking about the regulation, can you just talk about what other features does an OBPP regulation offer? Like, of course, you have to bring regulated products. You have to get all your products credit rated. Uh, what other features are present in the regulation?
Yeah, so in this case, first OBPP, you have to have an OBPP license to now distribute
Sure,
bonds over a digital platform. Okay. The second is, as I said, you can only bring regulated products to the retail users. What that means
sure,
in our case is that all our like we can't bring unlisted bonds on the platform. We can't distribute unlisted bonds on the platform. Um, there is a periodic scrutiny from regulators like SEBI on the governance of the platform and the conduct of the platform.
sure.
Before coming into the specific features, I just want to say that again, going back to what Aditya was saying, these regulations are they converge for the protection of the retail investors.
Retail
So
investors,
be
yeah.
it regulated products, like we keep saying that, and regulator also says if you're going and venturing into unregulated products, that as an investor you are taking a lot more risk than investing into a regulated product, right? Scrutiny from the regulators. These are all things that finally provide that protection to the retail investors, while institutional investors can hedge their bets because of just by the virtue of the information asymmetry and resources that they have.
Sure.
Coming to more tactical requirements that the OBP license has done, like for example, the exchange of money or the entire transaction happens through NSE's request for quote mechanism or
Okay.
NSE's RFQ mechanism. What that has meant is that the transfer of money and the transfer of securities happen through the exchange. Now, in an unregulated platform, that can happen through the accounts of the platform, right? So that's where
Sure.
you bring the platform risk, or as we call it as franchise risk, where the platform through which you are investing can touches the money
Sure.
that the investors invest. In this case, since it is happening on the exchange, both the money transfer and the securities transfer happen through the exchange, which is a big governance protection for the investors.
Sure.
These things have also reduced your minimum investment size. Like all payment mechanisms are in play now, be it UPI, net banking, etc. While in earlier cases only RTGS mechanism was there, which led to a 2.5 lakh to about 2 lakh ticket sizes. Settlement times have reduced to now T plus 0 or T plus 1 days. So these are the things that the regulations have brought along, which are
Got it.
100% in favor of retail investors.
Got it. Okay. Thank you, Vaibhav. Aditya, we're talking about OBPP regulation. From your perspective, are there any, let's say, disadvantages of having the OBPP regulation, which maybe the regulator should consider as an improvement?
Wrong person to ask this question. Vaibhav is probably the better guy to ask this question. But
No, because I want to know your perspective and then I'll move on to Vaibhav. But yeah, I mean, just a high level perspective.
look, to be very honest with you, from a high level perspective, I think one thing which I've always thought can be introduced is, once there is a certain vintage that an OBPP acquires, and that vintage can be decided by a regulator in its own wisdom. It could be 1 year, it could be 2 years, it could be 3 years, whatever it is. I mean, there are enough and more methods to track it. Then perhaps the basket of products that is available can be expanded. I mean, see, an OBPP's job is ultimately to present choice, and it
Hmm.
is to present choice in a manner that is A, regulated, B, transparent, and C, that is meaningful. As long as a track record of that is established, then perhaps we can actually expand the basket of products that is offered. I mean, look, you can correct me if I'm wrong or not, or if I'm right or wrong on this one, but I'm not too sure if listed commercial papers are offered on an OBPP platform.
Mm.
No reason
They
why
are
they
not,
can't
I
be
think.
offered.
Yeah.
Equally speaking, there could be, I mean, an OBPP could also function as a bit of a distribution channel as well because it anyway has a stockbroker's license. Or rather,
Mm.
I mean, there is a licensing mechanism to it. So, effectively, the one thing that I'd say is that, look, if you're establishing your ability to deliver transparency, to deliver choice, and you're to deliver both of these things in a more meaningful manner to the average retail participant, then perhaps the basket of products should actually be expanded. Don't do it for
Mm.
anyone who just applied yesterday or who's just become an OBPP. But again, when someone's proven their track record and has repeatedly established that they are able to maintain their track record, then you can expand the basket of products that's actually available to the average retail customer, client, what have you.
Sure.
Equally, another thing that could be done here is, let's say, you know, there are various measures that I think SEBI is discussing to, improve retail participation, such as, say, an NCD with a 10,000 rupee face value.
Sure.
Maybe you can look at something which has been fostered from day zero by an OBPP, and that is something that can have a slightly differential face value as long as it meets certain requirements. So various things which can be done. Overall, I'd say that, look, effectively speaking, as we should probably consider treating an OBPP as, say, a trustworthy channel for distribution to retail participants who can
Mm.
broaden, or rather which can therefore broaden the overall retail market participation. Because, look, ultimately that is going to happen. The reason we are talking about retail, the reason we are talking about unregulated products is there is a demand for it. There is no
Mm.
reason for someone to actually access those unregulated products if there is no demand for it. The best thing that
Sure.
we can do, therefore, is to regulate it and to ensure that, it is provided in a regulated, meaningful manner to the retail participant where there is an adequate level of choice and there is an adequate level of analysis and decision making. So that's my two bits on that.
Okay. Perfect. Thank you, Aditya. Vaibhav, anything more
Yeah.
to add there?
I mean, I just wanted to say that that's very nicely put by Aditya, like how you can think about OBPP. And I mean, funnily, OBPP is online bond platform provider, but I also believe that there could be, a large number of products coming into, this regulation, and maybe the name will start sounding as a misnomer. We are already
Mm.
hearing that SM REITs are something that OBPPs can distribute now. So good regulated products, trusted and governed channel for distribution to retail investors, uh, coupled together seem like a good recipe for the penetration that we are all looking for in terms of retail participation.
Okay. And any cons of the regulation, Vaibhav, maybe the advertising code or anything where you think, the regulator can definitely improve?
Um, yeah. So Yash is putting me on a spot here. I think I should take advice from Aditya before talking about it. But yeah, see, first things first. Okay, we are like we are a 1 year, 1.5 year old OBPP company, and this OBPP association and everything have has given us a direct channel to talk to regulators on a very close basis, which in itself
Sure.
is admirable. Like, I mean, go 10 years back and like how much opportunity would companies like these will have to talk to executive directors of SEBI on a day-to-day basis, right? So there are definitely, good things about regulation and this association and the channel that the regulators are creating, and also being so proactive about it, right? But again, there are differences of opinion, and I think I keep going back to Aditya because like he's just showering so much wisdom. But around that, prescriptive regulator versus having more foresight, etc. So for advertisement code is one one such thing. Like the first version of advertisement code that was proposed restricted us from even saying that we offer fixed income securities, right? And if you think about awareness of fixed income instruments, debt instruments in India, I think that is inevitable to do to promote any kind of awareness, right? And
Hmm.
that's what I mean. That is something that we are in deliberation with regulators now. The second thing was around referral or word of mouth, where Yash wants to refer a friend, and that's the strongest way of doing it. Strongest way of increasing awareness versus some ad campaigns and performance which could be misleading. Like a friend's trust is better in that sense. That has been on the stringent side, if I can say that, recently. So yeah, those are the things that we are in deliberation with. But again, it's healthy discussion. I think the channel is quite proactive and transparent about things.
Awesome. Good to know, Vaibhav. And I think you are one of the founding members of the OBPP Association as well, right? A couple of OBPPs have come together and formed a association. You guys generally regularly meet and then deliberate on these improvements and then reach out to the regulator? Or how does that overall process work?
Yeah, so that's what I was talking about. So
Sure.
so OBPP regulation came in, and then a few OBPPs formed this association, and now new members are joining that association along the way. And the
Got it.
genesis of the association was, like it's very hard for the regulator to also listen to each platform on an individual
Hmm.
basis. Association puts together a collective view on things. So the association comes together, forms a view, and then puts it to the regulator. That becomes a far more productive channel and also a more efficient one. Um,
Got it.
yeah, and we have actually made a lot of progress in these discussions and how OBPPs should operate, how some of the things should be looked at from a fresh lens versus other instruments, and being like fully prescriptive versus thinking about some of the growth ideas on as a collective industry together. Uh,
Sure. Okay.
yeah.
Okay. Thank you, Vaibhav. Um, Aditya, SEBI has a crystal clear focus on bonds, at least, or the fixed income market, as far as I can see, reducing the face value of privately placed bonds from, let's say, 10 lakh to 1 lakh, 1 lakh to 10,000 rupees, and now the OBPP framework, and now the liquidity paper as well, which recently came, I think, on 16th of October, if I'm not wrong. Why do you think there is this increased focus on bond market in general right now, from the regulator's perspective?
Yeah, well, yes, to go back to something which we discussed about a few minutes ago, there is a demand for it. And where there is demand, you will find some of the other form of supply. So it's best to, regulate the supply and to ensure that it's actually provided in a proper manner with proper disclosures. And look, you cannot prevent loss, but you can certainly enable proper decision making. So that's one. So look, let me put it to you this way that the regulator has been fairly, I mean, I could be wrong in the sense that there are various people who have various views, but let's actually look at the progression of the face value itself. Historically, until say about July 21, 22, there were no restrictions on face value. You saw face value of say 10,000, 1,000, 1 rupee, even odd numbers like 15, 16,000, and all of that. So you did see that. Then, of course, there was this, straight shot regulation that, all NCDs, all listed non-convertible debentures need to have a face value of 10 lakh rupees. That shifted a large part of the market into the unlisted space. Now, the demerit of shifting a large part of the market into the unlisted space is obviously disclosures are fewer because the unlisted market moves faster and perhaps it's not that well geared to cater to say retail participants, and it's largely geared to cater to say institutional participants dealing with each other. And at the same point of time, you see the regulator has recognized that there is a desire, a hunger, if you will, for retail participants to actually access this as an alternate form of investment. Ultimately, if you look at the average middle class person, I mean, you can go on YouTube also, and you will find that they are either listening to or are already participating in alternative investments, and they are at least receptive to it, which
Sure.
also means that there has to be some sort of a regulatory move to it. And you can't ban something. I mean, obviously there is a demand for it. Obviously, it's something that can fit into the current scheme of regulations, if you will. So let's perhaps try and figure out a way in which this can be implemented, and this can be implemented in the best way possible. Which, of course, then led to SEBI reducing the face value to 1 lakh rupees, and then considering other things, and finally coming up with another method of disclosure where the face value can be reduced further to 10,000 rupees. Now,
Mm.
that is still something that the jury is out on because it's a very new measure and things are still happening. I think Grips had already done something on that.
Yep.
So that's something which is happening out there. So effectively, what you're looking at is that it's a it's a fairly paternal sort of a regulator that we've got in SEBI, who is effectively not exactly say the woo-woo kind of regulator that look, go for it, let's do it, and let's see what we can get out of it, but more in the sense of that, look, let's figure things out, and we don't need to know all the answers, but even if we know about 60, 70, 80% of the answers, we are open to trying things out. So that's, I think, the kind of the regulatory mindset that you're really looking at right now. So that's again
Mm.
my view on things. And effectively speaking, what you will be seeing here is that, look, I mean, it's the easiest thing on the planet to turn around and say that, look, this regulation is not fostering development. What do we do now? But what you also see here is that, look, as long as there is a demand for a product, and as long as that demand has not been snuffed out, the product will grow. I mean, take again the mutual fund industry. They have had some hiccups in the past. Not every regulation, not every circular has been greeted with, this is a great thing, and we've heard enough and more about the periodic upheavals, about, say, reclassification of mutual funds and so on. But if you look at the raw numbers, the raw statistics, the mutual fund industry has grown on a Y on Y basis, and it continues to grow. And it continues to spread into not just the tier one and tier two cities. I mean, historically, if you look at stats, Bombay and Delhi have probably had the largest number of mutual fund participants. And now you're looking at mutual funds expanding into the tier three, tier two, tier three, tier four cities as well. So effectively, my point simply is that, look, regulation should perhaps be, it's not all bad all the time, and it's perhaps born out of a fair degree of thought and analysis, and maybe it's born out of some considerations that you and I or any of us don't really know. But as long as there is a demand for a product, and as long as that product is appropriately regulated, you do go back to the fact that you are increasing the ability of the average retail participant to engage further in that market and to participate further in that market, and also to therefore thereby grow that market itself. And the MF industry is a classic case. I'd say you'll probably see something on that in the AIF industry as well. So effectively speaking, I think that's where we are positioned. I mean, that's my view on things, of course.
Got it. Okay.
Can I ask?
Vaibhav?
Can I ask one question to Aditya on this?
Yeah, of
Shoot.
course, go for it.
So so you mentioned how there was demand for unlisted products, and but the face value in listed was X and Y, and then the it was cut down from 10 lakhs to 10,000. Do you think it could have been done faster? Because in the end, the dots get connected. But do you think that the regulator could have moved at a faster pace on this?
Look, it's a bit of a controversial answer. I think everything can be done faster, but should it have been done faster? And I'd say that the jury is still out on that one. Not for any other reason, but look, if you speak purely from a regulatory perspective, they'd rather lose out on a couple of months of demand as long as they are able to be confident about, creating demand in the market for the next 20, 30 odd years. Now, one thing I'd certainly say is if you look at again what the Ministry of Finance is up to, if you look at what RBI is up to and SEBI is up to, they are also probably looking at it from a really, really macro perspective also. And when I say macro, perhaps a macroeconomic perspective as well. I mean, if you go back to, I mean, irrespective of the political regime there, everyone's wanted to improve and expand the bond market. Everyone's wanted to improve the participation in the bond market and so on. If you look at various SEBI reports, they always seem to be querying that, look, what is the difference between a Reg 144 issuance and what we are up to? Why do we not have greater retail participation? My sense on this is that if you look at what the Ministry of Finance thinks, if you look at what RBI thinks, if you look at what SEBI thinks, and the case in point is, of course, companies rated as AA and above have to, necessarily raise 25% of the incremental borrowings from the bond market. So effectively speaking, what you are looking at here is that the regulator is perhaps taking more time simply because the number of variables that they are factoring into their decision making process are far greater than the number of variables that, say, you and I would consider while factoring into our decision making process. Could it have been done faster? For sure. Should it have been done faster? I don't have an answer for you on that one. That's again my perspective.
Go ahead.
Fair. Okay. Vaibhav, another question to you. We're talking about regulation, protection of retail investors. You know, cases of misunderstandings can still happen, and let's say a customer is unhappy with grip, or how they have been serviced, or they haven't been given the product that they were promised. What can they do about that? Like, how can they probably reach out to the regulator as well to complain about grip if they have to?
Yeah, I would say first reach out to us, and we are very proactive in solving our user investor grievances. But having said that, again, the regulations provide for, so every OBPP has to address the investor grievance in 30 days, within 30 days, and also has to report it to SEBI, report back to SEBI on how many complaints were lodged, how many complaints were addressed, and how many were resolved and how many are still unresolved. So that's the kind of strong that's the kind of strong framework that has been put on OBPs, and this can be done through scores, which is SCORES. It is SEBI's platform for investor grievances. So investors can use this platform, and OBP has to mandatorily address the grievance in 30 days. Just adding on to that, one more thing is that for OBPPs, it is mandatory to appoint a company secretary as a compliance officer. Again, I mean, small thing, but not a small thing actually. May not seem too big from a user perspective, from a front end perspective, but a compliance officer in a company, and even if you are starting out as an OBPP, is a mandatory requirement. So yeah.
Got it. Okay. Thank you, Vaibhav. And Aditya, coming to you now, GRIP is a regulated platform, of course, so there is a recourse, there is a complaint mechanism. But what if, people or retail investors still invested some of their money in an unregulated platform and then lost their money? What recourse do they have towards that platform, and where does the regulator come into the picture?
This is a bit of an open season sort of a question right now because, frankly speaking, it's a bit of a mystery right now. For instance, without taking the names of any unregulated products, and I know what Weber has said, it's perhaps not unregulated as much as there is nothing which is there to, put some sort of concrete framework around it and all of that. But effectively speaking, I'd say that, look, uh, I'd like to believe that there should be some sort of a adjudicatory mechanism which is there to enable investors in unregulated products to recover their money. As of right now, I don't exactly see that happening. I'm not entirely sure if the consumer courts can address this. I'd say that somewhere around financial thresholds themselves would perhaps not really pan out or not really work out. Whether a consumer forum could actually absorb and understand complex financial products, and they're getting more and more complex by the day. That's also not
Yeah.
something, or are they equipped to do that? That's also not something that will really pan out. Equally, are courts an appropriate forum for this? I think much the same reasons still apply here as well. I'm not entirely sure that that will pan out. And whether there will be that degree of understanding of a sophisticated product, again, I'm not entirely sure. Now, effectively speaking, I do think that there should be perhaps some sort of an adjudicatory mechanism. So if you look at again SEBI's website, you do find that there is some sort of a mechanism of a complaint, of an adjudication order that is passed, an attachment of, say, or other warnings that are issued to various persons. For instance, on a day-to-day basis, if you open SEBI's website, on the press releases, you'll see that, so and so warning has been issued to an unregistered investment advisor.
Hmm. Yeah.
So and so person has had some proceedings commenced against them, or an unregulated CIS has had their assets attached. So I'd say that there is something in the background which is there where the regulator either takes suo moto action or responds to a complaint which is actually made to them. Is there a formal mechanism for this? I don't exactly think so. No, not really. Should there be a formal mechanism for this? For sure, there should be. And perhaps, is there something that we can do to equip our consumer fora with the ability to actually either monitor this or to adjudicate this? It's not a bad idea, but we should probably workshop this a little more. That's again my thought on this.
Got it. Okay. So realistically, not a lot of protection if the consumer does end up losing money in an unregulated platform at this stage. But we should have something for sure.
Mhm.
Agreed. Okay. I think I am done with my questions, but there are a lot of questions coming in from the audience, especially for you, Aditya. Uh, okay to move into the questions, or do Vaibhav, do you want to cover anything else, or Aditya, anything more we should add?
I'm good to
No,
No?
move
no,
Okay.
good.
to questions. Yeah.
Mhm.
Awesome. So let's move on to the questions. Aditya, question for you from Sonal Banerjee. I don't know how relevant though. She's asking, what are your views on the current taxation on bonds? Will there ever be a parity with LTCG? And
Okay, fair
probably let's also
enough.
talk in about SDIs because you're on the securitization committee, and SDIs have a TDS of 25%, which is a big pain point for some investors as well. So probably let's cover that as well.
Look, so here's the thing. Let me answer the second question first because it's a little more close to home. Yes,
Sure.
so there should be some sort of, there should be some sort of tax moderation, if not a tax break, with respect to investments in securitized debt instruments.
Hmm.
The way India typically works is, just to give you a really, really anachronistic example, way back in the 1970s, I think the Indian government wanted to promote farming of mushrooms and so on and so forth. And I'm not kidding, they actually did this. So they actually introduced some sort of a tax break that, look, if you farm mushrooms or if you have an outfit which is like a small scale industry, then you are entitled to some sort of a tax break and so on and so forth. Now,
Okay.
that's a fairly anecdotal thing, but if you move on to more modern times, you'll see market linked debentures, which used to be done in a fairly high volume until very recently. Also were very, very popular as an investment product simply because they were accompanied by some or the other sort of tax grace. Not a tax break, but some sort of beneficial tax treatment and so on. If you look at the current budget, I think a whole lot of investors were up in arms about, the classification or the reclassification of, say, investment and debt products and so on. I'd say that, the one sort of moral that speaks through all of these examples is that if you have some sort of beneficial tax treatment, then you have an excellent chance of fostering a product. And until it acquires some degree of volume, until it acquires some degree of stability and some degree of, interested participation by the retail public. And once you
Hmm.
have that, then maybe you could try and look to scale back the participation, or rather, you could try and look back to scale back the tax grace that has actually been provided on this. Unfortunately, I can't really comment on the actual application of LTCG. I'm not a tax expert, and it would be not entirely accurate of me to offer an opinion there. But I'd certainly leave one thought here, where if you're looking to foster a market, then we should certainly have some or the other sort of favorable tax treatment, beneficial tax treatment associated with it. You need not have something permanent, have something with a sunset clause. There is absolutely no reason why you can't have an SDI which has some sort of a favorable LTCG for about, say, 5 years from now and have a sunset clause. Let's say that will not be applicable at the end of, say, 2029 or 2030. That's absolutely fine. But then you're essentially giving a signal that, look, we like where this is heading to, we are willing to regulate it, we are willing to foster it. And once it acquires some sort of scope and volume, then you're on your own. And that's perfectly acceptable. But you still need to encourage something, and that's a favorable tax treatment is one way to do that.
Got it. Okay. Thank you, Aditya. Another question is, most of the OBP platforms, and I might be wrong here, they don't allow NRIs to invest in the products offered by OBPPs. What do you, I mean, how do you feel about that? Because NRI is allowed to invest in the equity market. Why not the bond market or the SDI market?
My sense on this is that there should be some or the other sort of regulation to it, and that's pretty much all that can really be said on this for right now. I think the enabling framework is not there, and once it's there, you'll probably see an uptick in that as well. I am aware, anecdotally, of course, that there is something or the other happening in this market, but I have to confess, I'm not the most knowledgeable about NRI participation in, debt products.
Got it. Okay. Thank you.
Yeah,
Um,
but
Vaibhav?
this is one example where we would like to engage with the regulators on both, actually, one on TDS, on SDIs, and NRI participation. However, it is on TDS. It is not a matter with SEBI. It is a matter with a different industry. So that's one thing. But NRI participation, like, we continuously get a request or demand from NRIs to invest in these products. But right now, this is one example where we could take where regulators can take a more generous view.
Sure. Okay. Thank you. Vaibhav, another question for you is from Saurabh Wadhwa. Will there be any fractional ownership or CRE be available on GRIP platform once the SM REIT license is issued? And they've mentioned a third-party platform, but I think it's generic. You can work with any platform uh,
Yeah.
once they have the SM REIT license. So,
Yeah, so as I on in another context, as I mentioned, that SM REITs are something that are being discussed, or I think it's mostly approved that they can be distributed by OBBB platforms. This is one of the things that is in roadmap on GRIP. Uh, I don't want to commit to any timelines, but yeah, sort of like keep on keep a lookout on this. I think they will be on grip very soon.
got it. Okay, thank you, Vaibhav. Aditya, one question for you, and looks like the person is asking for maybe a legal opinion. Uh, the person asks, is there any risk on GRIP for the past unregulated actions that can risk my current SDI investment with them? And he specifically
Okay.
tagged Aditya,
I like
not Vaibhav.
I like how this question is addressed to only Aditya and not me.
Look, so I'm going to take the easy way out on this one. I do think that that's a matter for discussion between Grip and the person who's asked that question. And yeah, and perhaps in a more, shall we say, bilateral forum, if you will. So yes, that's something that can be considered and done. But yes, you're right. It would tantamount to legal advice, can't be done in this forum. But yes, it should be taken up in a more bilateral setting.
Got it. Okay. But Vaibhav, if you want to add anything, just
I think the question is not so much that. I think the question is around, Aditya, if someone makes an SDI
Mhm.
investments in SDIs today, then would any actions on your other products, etc., other products platform impact those investments? I think it may be useful for the audience to bring out the franchisee remoteness or bankruptcy remoteness of SDI as a product, if you would like to.
My sense on this, Vaibhav, is it would be a fairly vast, shall we say, scope of an answer on this one. Right? Probably end
sure.
up talking on this for a fair bit. So, not to cop out on this one, but I am conscious that we'll probably end up speaking on this for a fair bit. But look, you hit upon the absolute nail on the head that look, if you have a securitization product, it is bankruptcy remote in the sense. that the assets lie with an SPV, which is usually incorporated in the form of a trust, and therefore it would certainly be immune from any sort of actions that visit the originator and, for that matter, the servicer. Very, very frankly speaking, the platform itself doesn't really have a role to play once the asset has been distributed or once the asset has been placed, and the asset in this case being the securitized debt product. And again, not to sound, shall we say, not to give a doomsday bent to this or anything in that sort, but look, the platform and its relevance applies with respect to, say, the distribution of it, and not really, say, the performance of the asset itself. The performance of the asset itself will continue to lie with the underlying trust, or rather the underlying SPV which holds the assets, and of course the performance of the underlying itself, which could be in the form of, say, anything which generates cash, which is then distributed onto investors. So yes, I think the answer to this, classically speaking, would lie in the bankruptcy remoteness, and that's exactly the right thing to say. More particularly, it would probably involve a fairly long-winded discussion on this one as well, in terms of hows, the hows and wheres and whys and all of that.
Yeah. Okay. One more question, which I've got from the same user, and nothing to do with Aditya Weber, but is this a grip marketing session or educational session? Purely an educational session. The whole Alt Extra series is about educating and bringing out access to the most influential people in the industry and getting you answers directly from them. So very, very fortunate to have Aditya and Vaibhav, both of us, both of them here today on this, and purely from an education point of view. Uh, uh, and the person who actually asked about the past actions, unregulated actions, has just commented that I trust GRIP, just taking the benefit of Aditya's presence here. So all good there, Vaibhav.
Thank you so
And
much.
one more question that is pending right now, Weber, is when is GRIP launching P2P? P2P is good for granular diversification and regulation, and is also a regulated instrument. So,
If I can be witty, I think this is Yash's favorite topic. But so Grip is, to be honest, Grip is not looking to launch P2P anytime soon. P2P is a regulated product, but I don't think it comes under the OBPP regulation per se. Having said that, having said that, yeah, I think we have seen how P2P is going through a transient phase. So we are not looking at launching P2P now or in future. Uh, but I would urge you to still look at our SDI product where we securitize loan receivables, which is kind of similar to P2P because the underlying are still personal loans. However, it is a much more robust structure in terms of security, risk. This is a rated product and still beats the returns that you get in P2P for the most part. So, yeah, I would really urge you to look at those products right now.
awesome. Okay. I think we are almost at the end. Uh, yeah, I think everyone has asked their questions. Just double
I
checking.
saw one question where
Um,
someone I saw one question where someone asked that can they invest decent amounts in bonds through HUF? There
hmm.
was a Yeah, so
Whether
essentially,
you
yeah, HUF can invest in bonds and SDIs both. I think as an HUF, if you have equity exposure, it is a good way to diversify into fixed income portfolio as well. And feel free to check out GRIP or reach out to us.
awesome. Okay. Any closing thoughts, Aditya, before I, say bye bye to our audience?
So I'd always be on the side of regulation which fosters growth rather than, say, regulation that snuffles or stifles growth. And I do think that we should be looking at an environment where regulation initially is a bit of a bitter pill, but ultimately it does end up fostering some of the other sort of growth going forward. And personally speaking, I do see the market expanding. I think folks like Grip and maybe a Wintwealth and all are doing fantastic work. And all things being equal, I think the story is just beginning for folks like them. And I personally believe that their role should be expanded and they should work hand in hand with the regulatory framework and all of that. So, but again, that's my parting thought on this. And yeah, that's my parting thought on this. Yeah.
Okay, Vaibhav, anything, any last thoughts?
Yeah, fully aligned to what Aditya said. I think regulations are only helping this industry to grow with confidence. Uh, there are there are a few things that need deliberation and maybe just that just that a little bit of a push and a jump start to fasten the pace of growth of this industry, and then regulators can take a more stringent view once the industry has grown to some scale. Having said that, if you see the retail participation now in terms of number of transactions, number of trades happening, and albeit a smaller base, but the growth has been really taking off. So yeah, a lot of headroom to grow, a lot of opportunity for retail investors to participate into. I think most OBPPs are doing a phenomenal job. Um, yeah, and a good place to be right now, both as a
Awesome.
trader and as an investor in fixed income.
Awesome. Okay. Thank you, Vaibhav. And thank you to our audience who joined this webinar. I know we are in the Diwali week, so appreciate you guys, still trying to come for this explainer session on the OBPP framework. I would like to thank both Aditya and Vaibhav for sharing their insights transparently and effectively with the wider audience as well. If you have any more questions for our guests, you can reach out to me at yash@thealtinvestor.in, or you are very welcome to join the Alt Investor community if you're not a part already. If you did like this webinar, do share it with people who are maybe investing in unregulated products to make them aware the need of regulation and how regulation fosters growth, and make them aware of what can happen if they lose money in an unregulated product. Thank you for tuning in and have a really, really good evening. Thank you.
Thank you, everyone. Have a good
Thanks. Thanks, Yash.
festivities.
Happy Diwali.